now.
Ladies and gentlemen,
Please fasten your seatbelts.
Welcome to PreneurCast.
You know, business cards being swapped, beers being drunk.
Can I say a nasty word? Can I say procrastination?
With Pete Williams and Dom Gocher.
How well did that go down?
We can talk about that entire thing in a very another rant and soapbox episode if we want to.
Visit us online at PreneurMedia.tv.
Hi, Dom here, and this week Pete is interviewing Jack Delosa, founder of the Entourage and MBE Education, two companies set up to help support and educate young entrepreneurs under the age of 40. And in this interview, Pete and Jack talk about all different aspects of business, the stages that a business goes through from its foundation right the way up to an exit strategy and everything in between. So I'll hand you over to Pete and Jack.
Jack, welcome to PreneurCast. How you doing?
Very well, mate. How are you?
Mate, doing very well myself. So
Good.
I guess, rather than sort of me kind of, singing your praises, I always like to put people on the spot and make them sing their own praises. So do you want to give a bit of...
Which is a terribly awkward thing to do.
I know, and I love it. It always makes me feel good at the start of a conversation to get on the front foot. But do you want to sort of give a bit of your background and all that sort of stuff?
Yeah, very quickly. My introduction to business was quite stressful. I bought into my first company at the age of 18 and it went absolutely terribly. We were going backwards for about a year there, not taking money off the table, losing money, all of that sort of stuff, and working incredibly hard. I then went on to a second and third and fourth business, but to cut a long story short, what I'm doing today is we've got a couple of brands, one being MBE Education, which focuses on helping small to medium businesses raise money, buy businesses and sell businesses. And then we've got a company called the Entourage, which is Australia's largest educator and community of entrepreneurs under 40, doing our best to educate the next generation of entrepreneurs.
Yeah, and this is the really bizarre thing, that sort of those two things you spoke about there kind of culminating in how we know each other, which was really bizarre because back in one of your, past lives in one of those businesses, I was actually a client. My telco company did some stuff with you guys in a call centre type function. And then I was invited after speaking at an event in Sydney to come along to one of the Entourage events in Melbourne that you had recently, and I kind of sat in there and for a few hours and saw one of your presentations, which is sort of what sparked the topic for today's conversation. But it was at that point I kind of clicked. It's like, hang on, I knew who you were as part of the Entourage, and then kind of clicked that your history with the call centre that we worked with 6 or 7 years ago, I think it was.
That's right, and that cool. I was probably about 18 or 19 at the time, so I remember you as the guy who used to ask me questions that I didn't know the answers to.
Oh, mate, I'm sure the tables are going to turn around a little bit in this conversation, because the really cool thing that you spoke about in that presentation at the Entourage was sort of about the stages of business growth, because from what I see from the outside, one of the core things with the Entourage is to help people who have an idea for a business or something who's just started out, whether it be an internet-based business or a mechanics or someone who's manufacturing light globes. I think it doesn't matter what business they're in. You sort of come along, kind of hold their hand, for want of a better term, and help them through those growth stages to the point where obviously there's an exit on some degree. Is that a fair analogy of what the Entourage is all about?
Yeah, absolutely. That's exactly right. So we look to partner with early stage business owners who are either in the seed stage or startup phase, or maybe even the growth stage of their business. And we sort of come in and have a discussion around how do we best help them commercialise this business, how do we best help them maximise the value of this business, and really, map out a 3 to 5 year strategy right through to the point of an ultimate exit 3 to 5 years down the track.
And I think the thing that resonated with me a lot watching you speak, and we'll delve into it for sure. I'm going to pull this out of you on the conversation today. Is that so many people I know that I see and speak with, and because I'm more about the marketing consultation stuff when I take on the odd client that I consult with and things like that. It's very much about the let's get a client in the door kind of stuff, and that's not. I don't really necessarily directly as my core focus help people give that exit path, although I offer that same similar advice. And that's something I really liked about what you guys are doing with the Entourage, is you're helping people just know the outcome of their business before they start. I always talk about knowing the outcome of your marketing piece before you start, but you sort of have that, okay, let's have a clear goal of where the business needs to go, and then backwards engineer the phases that you're going to go through to get to that, and then make sure you put the right things in place. So when you do have that exit, you're ready to exit, and you've done the right things to get there. Yeah,
and both are equally important, because as an early stage business, you will thrive or die based on how much cash flow you're able to generate in that business. So, in the startup phase or the growth stage of a business, 80% of the entrepreneur's focus does need to be on sales and marketing activities and bringing revenue through the door. When we extend the conversation and talk about capital raising and exit strategies, we do that because if you look at the BRW Young Rich list, or you look at any high-level entrepreneur throughout the world, whether it be Richard Branson or Warren Buffett or Donald Trump, even Janine Allen's a bit closer to home, an amazing Australian female entrepreneur who recently sold 65% of Boost Juice for $65 million.
Not bad.
That's right. If you look at where a lot of these entrepreneurs actually create their wealth, it's often the cash flow in the business certainly helps, but the number that you see next to their name on a BRW Young Rich list is often tied to the value of their company or the value of the company they've just sold, in which case they've cashed out of it. But it's not very often you see their wealth tied to the cash flow they've been able to generate. It's more about the asset value of the business which they're in or the business that they've just sold.
Yeah, and that's important to sort of have that, because I think one of the things you spoke about was sort of the multiples of what businesses are selling for these days, and I'd love to kind of explore that, because that's something we haven't really spoken about on the show at all in any sort of term. So I guess having that clear direction of that exit, because there's cash flow, and there's plenty of businesses out there that the entrepreneur, the owner, is happy to have and just keep running in the background, feeding them income. That's what a number of my companies are doing for me. It's just feeding me that sort of cash flow that allows me to do the crazy shenanigans that I enjoy doing and ideas and testing new stuff. It's not necessarily about an exit for me. So I think that the conversation today is not about this has to be the one way a business has to go, but if you're going to exit and you want to have a business that's worth a lot of money that you can exit, you've got to be very strategic about it very early on.
Absolutely, and you're absolutely right, mate. You mentioned the Entourage earlier, and the Entourage is a business that we haven't set up for commercial purposes. So, you don't start selling education to entrepreneurs under 40 to make money, if that makes sense. You do it because you love doing it and you want to contribute and you think it's necessary. So, we do talk a lot about exit, and my differentiator is if you are in this business to make money, to make big money, then you might want to consider an exit. But if you're in it for the love and the passion of it, then why on earth would you look to exit?
Yeah. So with that thing, I remember one of the slides that really resonated with me that you spoke about. And I know it's going to be hard to sort of articulate a slide over an audio podcast, but you kind of had the graph of walking through the phases that a business goes through if they're looking at having an exit down the track at some point, whether it's 3, 4, 15 years away. And that was sort of something that I really liked the way you articulated that on stage. I'd love to sort of discuss that and kind of go through those phases and what you think the business owners should be focused on at those stages. Because I think without that sort of, I guess, context and understanding, I think, startup entrepreneurs and even, mature entrepreneurs who kind of just have a business that is really just a job. And this is, so many people, and, I think people have heard this so many times but don't really live it or engaged with it, that, your business is either going to give you a residual income with freedom, it's going to give you a big chunk of cash at the end, which is freedom, or it's going to give you a permanent job which you're stuck to. And I think one of the things you guys spoke about, which is really cool, is how your mindset has to actually shift as your business grows. If you're wanting to have that exit, you have to actually change what you do as an entrepreneur. And I'd love to sort of go through those phases if we can.
Yeah, totally. And just on that, Pete, I'm more than happy to send over an image of that graph if you'd like. If you're able to put it below the podcast or whatever that the audience can see it, more than happy to do that.
Yeah, cool. We'll throw it up on PreneurMedia.tv, which is where the podcast lives, and all the show notes and archive shows for those who are just joining us. So PreneurMedia.tv is where the transcript of the show will be with Jack and that graphic as well, which will be awesome.
Fantastic, easy. And, Pete, you nailed it when you said the mindset of the entrepreneur does need to shift throughout the different stages, because what we're doing in the startup phase is very different to what we're doing, 5 years later in the exit phase, for instance. In the startup phase, you're the person doing everything. You're the admin assistant, you're the sales guy, you're the business development manager, you're the recruiter, you're the bookkeeper, etc. And you're wearing all the hats. But as we go up this growth curve and as we go from stage to stage, you should really look to dilute your involvement in the day-to-day operations of the business. And that does involve a change in mindset and a change in approach to how you approach the business.
Yeah. And also, I guess it's also the things you put in place too, because if you know that and have this, stage and awareness of the stages that, well, if I'm kind of trying to exit in 5 years, in 3 years into the business, I have to have this business doing this so I can focus on these things, which we'll speak about in a moment. Yep. Which means in year 2 in the business, you have to be doing certain things so you're set up that year 3 gives you what you need to be able to do what you need to do. Now, that sounds very esoteric and weird without kind of talking through the stages. And it'll make sense, and people might want to rewind at the end of the show. But so, yeah, phase 1, what's the starting point for most businesses?
Okay, so first stage of business is obviously the startup phase. Now, my favourite definition of a startup business is it's a teenager that doesn't know what it wants to be when it grows up. Yep. It wants to grow up. It probably wants to grow up in a hurry. It just doesn't know what it's going to look like when it does. The number one challenge, which the audience will see on the diagram that we've given them, the number one challenge for businesses in the startup phase is that we are simply uninformed. And what we mean when we say uninformed is that our level of market understanding, our level of consumer insight, our level of product to market fit or message to market fit is just simply not what it is going to be in stages 2, 3, 4, or 5. So, we say that the number one objective of a startup business is to fail and fail fast, meaning what you go to market with, chances are it's not going to work the first time. So you want to do it quickly, you want to do it cheaply, you want to do it as lean as possible, and you want to learn from that. And so you'll deploy a strategy, figure out what doesn't work, bring it back in, make some changes, deploy another strategy, figure out what doesn't work, bring it back in, make some changes. And it's just this constant cycle of iteration in the startup phase, because we want to fail fast so that we can ultimately reach a viable business model before we run out of cash.
Yeah. And I think from my perspective is that there's 2 things I guess you're testing at that phase. I would suggest from my experience and love yours, because obviously you deal with a lot of businesses as well. You're testing the actual offer, and what I mean by offer is the actual product. What is the thing, the box of things you're selling? That obviously has to change to meet the marketplace, but also the message to your market, the actual mediums, the sales letters, the communications, the way you sell it has to be tested as well. So they're probably the 2 things that you're continually refining at the same time,
100%,
as you're going out.
Yep. Yeah, and we in this discussion we'll talk a lot about building value and minimising risk and doing all of that sort of stuff. I'd suggest in the startup phase you don't even think about that. You just think about what is the quickest path to profitability, and that should be the focus in the startup phase.
Yep, completely agree. So once you're sort of going through that, and that may take 6 months, it may take 18 months, it may take a couple of years, depending on the business. Obviously, it's not these phases aren't necessarily a calendar period. You don't sort of go, 365 days in, I'm going to be stuck with this business model, and I'm going to go with that. It's obviously depending on the business of where you're at, of course.
That's right. And you won't necessarily go through stages 1 to 5 either. If the guys following along at home, if you look at the diagram, we've listed capital raising in the 3rd stage. You might actually raise capital in order to start up a business. So not even necessarily sequential. What I say is every model is useful, every model is flawed. So let this be a guide as to what are going to be the challenges and what are going to need to be the focuses throughout each stage. But you might do this in all sorts of orders.
Yeah, exactly. So if you've gone through this in hypothetical sequential manner, you fit in the perfect box. What happens after you've gone through, from your experience dealing with all these companies, after you've gone through that startup phase? What's sort of the next direction?
Absolutely. So at some point in the startup phase, you'll get that product to market fit. You'll get that message to market fit. As you said, Pete, your sales letters and your communications and all that sort of stuff should start to line up. And at that point, you'll head into the growth phase, which is where you'll actually see your bank account and your profit and loss statement start to go up, which is always a lovely surprise after you've spent the startup phase probably watching it go backwards. Yeah. Throughout the growth phase, what it's about then is scale, and how do we scale as effectively as possible? If you have taken the time and taken the risk to find and discover a viable business model, it would be such a waste to just let it sit there and tick over, generating $100 or $200 or $300,000 in profit every year. If you've got that viable business model, your next focus needs to be, how do we leverage this? How do we maximize it? And how do we grow it to its fullest extent? Yeah. The number one challenge we see in businesses in the growth phase is that they are unleveraged, and by that we don't mean that they need more debt. What I mean is that their sales and marketing strategy is unleveraged. Yeah. So, you'd know yourself, Pete, most business owners might have one meeting with one person, another meeting with another person, and they might have 10 meetings with 10 prospects in the hope of getting maybe 1 or 2 clients, in which case they've invested maybe 10 or 20 hours and ended up with 1 or 2 clients. So the number one strategy, or the number one driver through the growth phase, needs to be, how do we leverage our sales and marketing? And I'll give you 2 ways very quickly of how I suggest you do that. Firstly is through strategic partnerships. How do you partner with complementary companies that can drive your business on a continual basis? And the second way to leverage your sales and marketing is through PR, which is something else I know that you specialise in, Pete, is how do we get visibility and traction through the media so that opportunity starts to find us, customers, investors, joint venture partners, staff. How do we put ourselves in a place of visibility where those sorts of opportunities start to find us?
Yeah. So let me ask you this question, which is probably a different sort of question. What is the calendar and the diary, like the actual actions the entrepreneur is doing differently between those 2 phases? Obviously in phase 1, they're very much face to the grindstone, writing the sales copy maybe, or at least doing a lot of the testing and the marketing and the back and forth and adjustments. In phase 2, they're obviously putting in more systems in place, maybe hiring more staff. Is that sort of where you'd traditionally, the working on the business and growing the business comes into from a traditional sense in phase 2, or would that be part of phase 1 as well? Where does that sort of fit?
Yeah, it's sort of like in phase 1, you're sort of figuring it all out. Yep. And then you've figured out the formula. You figured out, okay, I can generate this, I can sell it for this. If I say this, people will be interested in it, and hopefully it'll end in a purchase and an ongoing client. Yeah. In phase 2, we're looking at, okay, now that we've got that, how do we start to ramp it up and make more noise about it and gain more distribution through more companies or more media agencies? So how do we get the megaphone and start to make more noise about it? So
you're hiring sales staff to sort of,
absolutely,
they're
exactly
replicating
right.
that, they're doing that script, which is obviously we talk about quite a bit on the show, is about having replicatable systems like sales scripts that everyone knows works, and these are the things that works to sell our offer to our marketplace. And then you have that in place, and then obviously you're moving away from the actual face-to-face selling, and you're worried about how do you fill up that funnel more.
Totally. And the growth phase is where you should start writing all of your systems. We spoke earlier about the need to dilute your involvement as you go through the stages. That should begin now in the growth phase. If you're bringing in more cash and you're able to bring on more people, et cetera, then, everything from operational systems through to sales systems and marketing systems and HR systems should begin to be documented so that you can further dilute your involvement. So, yeah, mate, I've lost my train of thought.
So once you've sort of done that and you've kind of worked out your systemization, you've gone for that phase 2 and you're screaming, you're getting much more leads and consumers and customers and prospects into your marketing funnel through the growth phase, and your business is actually now growing beyond just you. It's giving you that expansion. That might be when you open a second office or a third office. What comes next in this particular model of growing to exit?
Yeah, absolutely. So, as a business grows, what is counterintuitive to a lot of business owners at this stage of the game is that growth devours cash. As you bring on more staff, as you need more infrastructure, as you need a heavier website, as you need a heavier online strategy, a lot of the time, more product, more logistics, whatever it might be, a lot of the time growth can devour cash. So we then enter into a phase of capital raising. And this is where we might look at external investors or external lenders that might want to inject some capital into this business to further fuel the growth and development of this business. Now, typically businesses will raise money for one of 2 reasons. The first reason is that they want to accelerate the growth even further, and they know that if I inject $100,000 here, hopefully $150,000 will come out the other side. The second reason being is to facilitate existing growth. So our growth curve is as steep as it possibly could be. We certainly do not want to spend any more money on marketing because we couldn't handle any more customers. But one thing we do need is we do need to shore up everything we're doing internally to be able to facilitate the existing demand which is coming into the business. So that's stuff like investing in systems, investing in your website, investing in more staff, etc., etc.
And I think that's something that, as you said, it's counterintuitive. And I've experienced this in some of my companies where, you go through phase one, it's a little startup and, it's making some good cash flow and, some of it's being eaten up while you sort of refine that business model. But then that sort of, while you're straddling that phase one, phase two, and even more so into phase two, the business actually starts spitting out some good cash flow and some good profits at the end of the day. Not huge
Absolutely.
Profits, but in terms of percentage of revenue, it can be quite enticing. You're making those 100, 200 grand a year net profit, which looks really sexy and is great. So then you decide, okay, well, hang on, let's ramp this up even more and open an office up interstate. We'll, put in a major accounting software package that can run and, optimize everything, whatever it might be. And that kind of sucks up a lot of cash flow. And then you suddenly go, well, hang on, my business 6 months ago was making all this money and I'm going through this phase to actually make more money, but I have less right now. And it's very counterintuitive and not, I wouldn't say scary necessarily, but that's sort of where a lot of businesses end up sort of getting choked and bottlenecked and die because they don't have that awareness in place that, the growth phase is almost more risky in some respects than actually the startup phase, because the startup phase you got nothing to lose.
Absolutely.
But once you've got a couple of staff and some systems, and even if you don't have a couple of staff and systems, you just have yourself and you're making, or only 3 or 4 staff hypothetically, and you're making a couple of $100,000 a year, that's more risky to lose than a job necessarily, when you're starting out with a part-time startup. So, having that awareness going, hang on, I need to actually think about this and have some strategies in place of how am I going to grow and how am I going to fund that growth without strangling the cash flow and strangling the entrepreneur's lifestyle and enjoyment for the business.
That's right. I think scary is the right word. I think it is quite confronting when, whether you're a personal trainer or a plumber or a consultant or whatever it is you're doing, it's so common for people that are now going through the growth phase to look back at the startup phase and think to themselves, I was making more money as a one-man band. At that point, the worst thing you can do is go back to being a one-man band because it was more profitable in the immediate term. And that's where it comes back to, having this foresight of the 5 stages that we're going through, because you really need to know where you're going, what you're building, and more importantly, why, and who's going to actually buy it at the end of the day. And that will keep you on track a lot of the time to keep progressing towards that ultimate goal.
Yeah, and I think, probably around the same time when you and I were you're doing some work with us as, that one of those companies you mentioned previously, a mentor of mine and my business partners at the time said to me, with one of his businesses, that he was having more fun and more enjoyment when you only had him and 2 staff as opposed to the 15 or 20 you had at that particular time. And I was like, you're an idiot. How does that, that doesn't make sense. And then as I kind of went through those phases for the first time myself,
you got it.
I was like, okay, I hear what you're saying. The grey hairs are coming through at the, in the mid to late 20s. That's not smart. That shouldn't be happening. I shouldn't have grey hairs yet. But no, you're absolutely right. And that's something that you sort of touched on there is about, I think something you mentioned, and hopefully we'll touch on it in a moment, the statement that you need to know who you're selling to. And I don't know if that's sort of relevant in the next phase, but I really want to hit on that because that's something that people don't think about either.
Yeah, totally. Pete, let's firstly dive down into when we jump into the capital raising phase, or again, whether it's this phase or whether we're doing it to start a business or whatever. It's really important at that point that we understand the psychology of investors. It's been proven. Wholesale Investor Magazine survey their 10,000 investors on a quarterly basis, and the number one thing that prevents investors from investing into private companies in Australia is not the global financial crisis, it's not the economic environment, it's not access to capital, it's not any of these things. The number one barrier to investors investing in private companies in Australia is, and I quote, not finding suitable opportunities.
That's amazing, isn't it? And I think I remember getting out my iPhone because, I apologise and I'll be completely open, I didn't plan to come and take notes. I was invited to come along and check it out, so I thought I'll sit there and might just enjoy the show, so to speak. But I was like, hang on, this is actually good stuff. I remember taking out my iPhone, opening up Simple Note, and actually making that note about Wholesale Investor Magazine and some of the stats you were saying, because it's like, that's such solid advice because, it's counterintuitive. Most people don't think that, but it is. You're literally having and building and articulating a good opportunity as a person trying to raise capital.
Exactly right. And, when they say not finding suitable opportunities, what that is saying is that the entrepreneur going to have the discussion with the investor is not prepared. They haven't thought through this deal. They haven't thought through the offer to make it attractive for the investors. So, Pete, I'll just give you the three questions. The quickest way I can sum up how to prepare for a capital raising phase is to run through what I call the three questions on every investor's mind. Everybody answers these three questions. Most people do it in the wrong order, and most people do it in a very unthorough type of a way. So let's go through what are the three questions on every investor's mind, and how do we get prepared for this phase? The number one question that an investor will think when they look through a potential deal is, will I lose my money?
Fair enough question to ask.
They are not yet thinking how much money I'm going to make. They are not yet interested in the blue sky opportunity. They are not yet interested in how amazing we think the deal is. The first thing they want is, how risky is it? They've seen so many deals, they've invested in so many deals, and they've lost money on so many deals. So the first thing is, will I lose my money? Now, what an entrepreneur needs to do in order to combat this is, what the investor is going to be looking for. Number one is the experience of the entrepreneur. Number two is the team and the mentors that the entrepreneur has around him or her. Mm-hmm. So if you're at the startup phase or at the growth phase, it might be your first business and you might not think that you have a lot of experience, in which case you need to develop a team of mentors and a team of advisors around you, and you essentially borrow from their credibility and their experience. That is sufficient for an investor looking to invest in an early stage opportunity. And the third thing they'll be looking for under, will I lose my money, is proof of concept. Yeah. How proven is it that there is a market for this? How proven is it that people will be willing to pay for a solution in this kind of a space?
And then the fourth thing, which is, I think from my experience, a very far fourth, is how much money will I make? That is the fourth thing I think about. And I think you're right there, because I've been invited to a lot of angel investment dinners where I kind of, go and get beautiful meal, nice red wine, and then 4 or 5 startups come in and sort of pitch their deal. And I'm sitting there, checkbook in hand, somewhat, some not necessarily. And then I'm thinking, okay, would I invest in these companies? And it's not necessarily about how much potential there is, because, the next iPhone app could make couple $100 million and be Angry Birds, but realistically, what has this guy got to prove himself? What's his track record? Where's he been burnt? What hardship has he been through? What track record has he done to be successful? And I think if I was going to open up and wanting some outside investors, not to sound overly arrogant and similar to yourself, it'd just be like, okay, this is who I am. This is the proof. This is the awards I've won. This is the credibility I've got. This is the companies I've built. And I reckon people would, and I know I would, if someone came to me and said, this is my track record. This is what I've done. This is it. I'm going to start a new business. Join in. Most people, if they're smart, would invest just on that, ignorant of the actual idea. But ignorant in a good way. That you shouldn't necessarily be, if someone's got a track record, has proven themselves, and the concept has some validity, you'd back that horse. You don't back the idea.
And that's what I mean, is the experience of the entrepreneur. If you can demonstrate awards, if you can demonstrate track record, that is the number one thing on the top of an investor's checklist in terms of what they're looking for. But will I lose my money? So that's the first question. The second question they're going to ask themselves is, when will I get my money back? Yep. So is the entrepreneur, what is the defined exit strategy, and is the entrepreneur committed to it? And then the third question the investor will ask, and only once they've satisfied with the answer for the first two questions, the third question they're going to ask themselves is, will I make money, and if so, how much? And that's when we have opportunity. Once we've lowered their resistance and proven that, yes, we have some experience, or yes, we have a team around us that has experience, yes, there is some proof of concept around what we're doing. Only then, once we've lowered the resistance, can we start to talk about the blue sky opportunity and the expansion plans, and are we building any strategic value into this business? And, these are the 3 or 4 potential buyers that might buy us in 3 or 5 years. Only then can we start painting the picture of how much money this venture might actually make in the future.
Yeah. And I think, so at this phase, when you're starting to raise capital, you actually need to have an identified potential suitor, because obviously I'm thinking from what you're just saying there between the lines is part of the pitch to the capital raising and the investors is that this is the exit strategy. This is who we're going to go after. This is why we're going to go after it. This is why they're going to buy it. Is that kind of the stage where you start thinking about that as well?
100%. So, a lot of the time, when investors invest into early stage businesses or private businesses, they're typically investing not for dividends. Of course, everyone likes dividends. Everyone likes a share of the profits to be paid out every now and again. That's a cherry on top. But they're primarily investing for capital gain, meaning I want to invest $50,000 or $100,000 in a business worth $500,000 or $1 million, whatever it is, and then I want to see that business be sold for $5 or $10 million in 3 to 5 years' time. That's the beauty of small business, and that's what attracts investors into this space, is the opportunity and the possibility of high capital growth in a relatively short period of time.
Yeah. Okay, so I know we're heading towards that direction. So once you've got the capital raising, you kind of are getting those investors on board and you've raised that capital, what's sort of the next thing that the business owner needs to start thinking about and the phase they go through?
Yeah, so now we come into stage 4, which as the guys that are playing along at home will be able to see on the diagram, is acquisition. So, obviously the next phase is phase 5, and that is exit strategies. And what a lot of smart companies will do, and what we advise our clients to do in the lead up to a point of exit, is we know that if we can sell a business for, let's say, somewhere between 4 to 6 times its profit. So this business is profiting $200,000. We know that we can sell it for somewhere between $800,000 and $1.2 million.
Yeah. That's the multiplier which people might have heard. Like it's a 4 times multiplier or it's a 6 times multiplier.
Exactly right. Now, unfortunately, the average multiple a private business achieves in Australia right now is 2 times profit. Anybody that works with us achieves a multiplier of 4 times profit or above. So we set the absolute minimum at 4 times. You shouldn't be looking to sell your business unless you're getting 4 times plus. Yeah. Obviously, taking into consideration your personal circumstances and all of that sort of stuff. Yeah. Let's use this case study. A business doing $200,000 profit. Let's say we're going to sell it for 6 times. We're selling it at 1.2. If we know that we can go and find another business, and that business is doing $100,000 profit, and as I said before, the average business, the average multiple that a business in Australia achieves is 2 times. Now we can buy that $100,000 for 2 times, which is $200,000. Mm-hmm. We then bring that $100,000 into our existing business that we're going to sell for 6 times, and that $100,000 we've just bought for $200,000 is now worth $600,000 to us, because we're trading at and going to sell at a higher multiple than the acquisition target we just bought. So now, rather than selling on a 6 times 200,000, which was 1.2, we're selling at 6 times 300,000, which is 1.8.
Very nice.
So with an outlay of $200,000, we've just added $600,000 to the exit price.
Now, I recall, and I could be getting this completely wrong, you gave an example somewhere around the conversation of the acquisition phase about an electrical company. Am I right?
Yeah, that's right.
Was it electrical? I knew it was some sort of tradie. Was it electrical tradie?
Absolutely. A guy called Brad McHugh is one of our clients in the Entourage. So this capital raising and exit strategy stuff is what we specialise in through our work with MBE Education. But we obviously do some of it in the Entourage as well. And Brad was a 19-year-old electrician, started on a program in the Entourage with us, and he was finding it hard to attract new clients because of his age. He was finding it hard to win new contracts. So, we ended up having the discussion, mate, why don't we just look for a business to buy and do it that way? So then you sort of acquire a book of clients rather than needing to build them from the ground up. Brad found a business that was doing $110,000 profit every year. Business was selling for $110,000.
So a 1 times multiple.
Exactly. Great multiple to buy it. Wasn't great enough for Brad. He went back and negotiated to buy it for $90,000. So he's buying it for
You never pay rack rate.
Well, that's right.
You never pay rack rate.
And so he goes and negotiates $90,000. He raises $100,000 from private investors that were within his network. So, most of the capital raisings that we facilitate come from the entrepreneurs network or come from our network. We rarely need to go outside, to professional investors, quote unquote. Brad raises $100,000, buys the business for $90,000, doubles his client base, doubles his revenue. Literally, we did that deal probably in over about 4 weeks' time. Doubles the size of his business in 4 weeks, and had $10,000 left in the bank for operating expense. So, Very successful case study as to, a lot of this stuff, it is difficult. There is a lot of detail to it. And if you are going to attempt it, you do want to be doing so hand in hand with an advisor. But when you do understand the process somewhat and you do have a good team of people around you that can help you do this sort of stuff, it does become a lot simpler. So much so that a 19-year-old electrician with no business experience and no business education can go out and acquire it in a month.
Well, two things. I've got a point to make which is completely irrelevant to our conversation, and I've got a question for you. When you sort of spoke about the tradie who wasn't old enough to get business, it reminded me of a story that I think Dan Kennedy told me, where he was advising a young, I'm pretty sure the conversation was a financial educator, so a young guy, early 20s, giving financial advice from stage. Now, obviously, if his target market is sort of the baby boomers, they're not going to want to part with their retirement funds to a 22-year-old. It just doesn't make sense. So one of the things Dan did was actually made that guy with that business hire a very older gentleman in a three-piece suit to introduce him on stage, to MC the Q&A session at the end of the presentation, and a number of other senior people in three-piece suits to be at the back of the room to sign people up. So they sort of surrounded this young kid with elderly people, mature-looking people, to give him their perception of expertise. He was very, very smart and was, very well educated and giving great advice, but obviously there's that positioning and perception. So just a random marketing suggestion that's completely irrelevant to the show that I thought was pretty cool. But a question that sort of popped in my mind that I don't know if you got an answer to it or not, but it might have popped in other people's minds is, a young 19-year-old kid who goes and buys another company, is that part of phase 4 where not only acquisition, but then you've got the whole management of integrating other companies? Now, I know a really good friend of mine who owns M2 Telecommunications, Vaughan Bowen, grew that business to a multi-million-dollar ASX-listed company off the back of acquisitions and done it very, very well. And for whatever reason, he's been just brilliant at being able to acquire businesses and have them fit that culture and that workflow from the outside and somewhat in the inside very seamlessly. How have you found that companies you've worked with have gone through that phase of the actual, not only the purchase is relatively easy when you sort of look at it from the outside, it's just a negotiation and then solicitors doing their thing. How does it fit? Like, what about the business fit? Have you had any sort of good stories, bad stories, case studies, examples around that at all?
It's certainly easier when you're looking at an acquisition which is complementary to a business you're already running. Yeah. So in Brad's case, if we were to look at this diagram, he was probably at the end of the startup phase, meaning he had worked out his business model, he was profitable, he knew what he was doing, he was just finding it difficult to scale. So he already knew what he needed to do in order to make the business work. He already had his culture, he already had existing staff, he already had existing systems, partly, through working with us and us sort of highlighting the need for all of that sort of stuff. So when it's a complementary business and it's a complementary acquisition, yes, there are always challenges in the integration, but it is far easier than perhaps acquiring a business in an industry which you know nothing about. So, your mate Pete Vaughan knows it's Vaughan, isn't it?
Yeah.
Yep. He knows the telecommunications industry and the telecommunications business inside out. So at that point, it becomes more about, less about sort of can I manage it and more about how do I manage such rapid growth so quickly. And
I think the crazy thing too is that, which you didn't touch on, but people might not be aware of consciously, is that the really cool thing about buying a complementary business, in Brad's case, if he spent 90 grand on this business that was making 110 grand profit a year, he's obviously got 20 grand off the top straight away in the first year back in his pocket.
Absolutely.
But there's generally a lot of economies of scale. So that operating cost to run that business that's now under his umbrella would actually be a lot less because, quite possibly there was some extra capacity for his admin staff and for his accounting team and things like that. So the actual operating cost of that business he's taken on will drop dramatically, and that $110,000 profit might have jumped to $140,000, possibly $150,000 in that first year, not by any more revenue coming in the door, just lower operating costs because of economies of scale. So he's technically not only bought, a $110,000 business, or $200,000 business if you look at the 2 times multiple. So he spent 90 grand, added $200 to his bottom line. Technically, it's probably more. So that actual $600,000 that or 1.8 million is actually probably going to be more because it's actually a...
Absolutely.
I kind of got confused in the articulation there, but that hopefully makes sense to people. I'm trying to do the math without visual whiteboard.
Yeah. Yeah, absolutely right, mate. There's two kinds of synergies when making a complementary acquisition, and the first is, as you say, a cost synergy. So, we might not need two accountants. We definitely don't need two bookkeepers. We might not need two receptionists. I'm working on an acquisition at the moment where two businesses are going to become, two businesses are going to merge into one office. So that's, $50,000 a year. Off the costs of the business, and that goes straight to the bottom line. Yeah. So cost synergies are a massive one. The second one is revenue synergies. There might be some services offered in business A which business B doesn't offer, and those services can be flushed through business B's distribution and client base, and vice versa. Business B might have some products and services which business A doesn't, and therefore those products and services will be distributed through business A's client base and distribution. So you're right. If the acquisition is done well, you buy at the right price, and as you rightly pointed out, if the integration and the ongoing management is handled effectively, there should be an increase in profit of the business you've just acquired.
Yeah, which makes those numbers look even more pretty.
Exactly right.
So let's say, okay, in this electrician's example, or anybody's example really, they've acquired a couple of companies or one company, and they've gone through this acquisition phase. Then obviously the final step is the exit. Is that right?
Absolutely. So stage 5, we come into the exit. Now the number one challenge we see with businesses going into the exit phase is what I mentioned before, and that is that they are undervalued. As I said before, the average multiple that most private businesses in Australia achieve is 2 times profit. At this stage, you want to be aiming for 4 times profit or above. Now, we do that through a couple of ways. Firstly, simply having foresight of the exit strategy, let's say 1, 2, 3 or 5 years in advance, just as a byproduct of that awareness and that knowledge, you will have created a business which is inherently less risky, inherently less reliant on you, and probably more valuable, particularly if you've brought on investors and acquired other businesses and all of that sort of stuff. So things to keep in mind is minimise the risk of the business, maximise the growth potential of the business, and, in terms of actually facilitating the transaction itself, the more potential buyers you can identify and the more potential buyers you can engage in some sort of a discussion with, the higher they will drive the price. It's no different for being at an auction. The more bidders you have at an auction, the higher the price gets driven. So if you can identify, why your business represents as little at risk as possible, why it represents as much growth potential as possible, and that there are other people interested in buying this business and they might be your competitors, then a combination of those factors will help drive the multiple and therefore drive the price even higher.
Very, very cool. So that's basically, those 5 phases. And I think you're right that if you want to have an exit, 3, 4, 5 years' time, I think you have to identify who those potential buyers can be, because I've seen plenty of businesses that I've worked with or consulted with or just seen that have grown to a sort of a ceiling, and then it comes to that point there's no one in the industry for various reasons that could acquire them easily. There's not an obvious buyer necessarily, or a synergistic buyer, synergistic. That's the word I'm looking for. Synergistic type.
I just want to jump in, mate, but I thought
Mate, I would have been here for 20 minutes trying to figure that one out. Synergistic buyer. So you need to sort of have that identified early, so you can sort of shape your business as part of that growth phase and acquisition phase to become more appealing for that person.
That's right. We talk about the 3 customers, and that is that every business needs 3 customers. The first is who's going to buy this product or service. Yep. The second is who's going to help us sell this product or service. So, do we distribute to wholesalers or do we distribute to retailers? Who's going to on-sell it to a wide range of customers? And then the third customer that you should know for your business is who's going to ultimately buy the business at the end of the day.
Yeah. And I'll be guessing on face value, some businesses will only have 2 customers. If you're, for example, to use this electrician example, he'd have obviously the customers who do the electrical work for. He's got the potential buyer one day. Would he have a third customer in that he's not actually dealing with a retailer, he's not a wholesaler or anything like that? Or is there a third customer that most people don't find obvious in that sort of example?
Yeah, a quasi second customer in that kind of example is who I touched on in the growth phase, and that might be some strategic partners.
Yeah.
So in Brad's case, he might have a plumber, he might have a bricklayer, he might have 3 plumbers, 3 bricklayers, some property developers and some real estate agents, all funneling him work and driving him business on a continual basis, in which case he's got, let's say 12 complementary businesses, which he has a good partnership with. So
I'm glad you went there, because that's what I was thinking, because so many people, they sort of, see themselves as the, the B2C type, supplier of whatever it might be, and they just don't think about the other sort of, that strategic partnerships are a huge way of path to market, even if you are doing direct B2C kind of stuff.
Exactly, that's right.
Very cool, mate. So that's I really enjoyed that presentation that you gave, and I know that presentation was part of like a one-day sort of overview event or seminar that you guys put together. Is that sort of how that all works? Because as I said, I literally ducked in there for a couple of hours after an invite from one of your team. So I don't want to sort of talk about the entourage, what it is, and sort of completely make you write checks you can't cash. So what is it? How does it all fit together? That one presentation, because that was in a whole amongst a whole bunch of stuff.
Yeah, that's right. So that day that you came to was the Young Entrepreneurs Unconvention. So the Young Entrepreneurs Unconvention is Australia's largest event for entrepreneurs under 40. Where we were in Sydney a couple of weeks ago and we had over 1,000 people come through the doors, and you hear from people like Matt Rockman, who founded Seek, which is today valued at $2 billion, or Ruslan Kogan from Kogan Technologies, who's Australia's wealthiest person under 30, and right through to young entrepreneurs like myself and Andrew Morello, who won The Apprentice. So it's just a good day where we come along, hear from some first-class entrepreneurs, and take home some real, actionable action points that you can start to put in place when you get to your desk on Monday morning.
Yeah. Oh, and I really enjoyed it. Like, unfortunately, I had other stuff planned that day, and I thought I was going to be in the city, so I got the invite, so I'd stick my head in the door, and I'm glad I did, because I timed it perfectly well with your presentation, which was great, and I definitely took my iPhone out and took some notes myself. So it was a bit of a surprise, to be honest, how actually enjoyable and how much education I got in the couple of hours I was there. So highly recommend people sort of
glad you came along,
going along and checking it out, because there's definitely some good content and good context to learn about this as well, because it's, as much as I love and say all the time that business owners need to get out from under the hood of their business and actually start selling and marketing, get away from the mechanics, and the core of a business should be marketing and sales, and that's sort of what we talk about a lot. But realistically, if you're wanting to grow a business, and that's what really gives you and sets you up for not just having a job, you have to be very clear about what your goals are going to be for the next 3, 4 or 5 years, and what sort of exit you're going to have, whether it's going to be a financial exit where you sell for multiple, or whether it is just an exit from the day-to-day business and just take the cash flow and sit on your couch at home or on your yacht. So if it is sort of that, you're interested in finding out more about how to actually go through the phase of an exit, which is sort of, I guess, what a core thing you guys talk about, I'd highly recommend getting along to one of your unconvention days, which is a very cool name. So is that available?
Pleasure, mate.
Very cool. So we'll put links on PreneurMedia.tv. So when you check out the show notes for this conversation with Jack, there'll be some links to the websites, and I guess some dates for upcoming events. You do these regularly around Australia?
Yeah, absolutely. We do them 6 times a year: Melbourne, Sydney, Brisbane. Pete, the other thing that I can do, we've got a capital raising for high growth businesses white paper,
awesome.
Which we've recently written, which just sort of outlines exactly what we've discussed today. It'll probably almost be a transcript of this discussion. If you like, mate, happy to send that over if you want to distribute it to the guys.
The more the better. I'll definitely throw it up there, and we'll get people to read it, because there's definitely some good value in that for some education. So, mate, thank you very much for your time. Good to connect after a few years too, since we did some stuff together as a client of one of your businesses. It was very, very sort of cool. I actually put out some old emails as well. I thought I got to see what some of the correspondence was 6 years ago. And the last couple of emails I found were you were ill, and you were just saying you're getting back on your feet after being sick. So I'm glad you sort of got over that little flu 6 years ago.
There you go. It's a very small world, mate. I'd love to see those emails if you've actually got them.
I'll forward them over. Thanks, guys, for listening, and we'll see you next week on PreneurCast.
You've been enjoying another fine episode of PreneurCast with Pete Williams and Dom Gocher. Make sure to hang out with the boys online at PreneurMedia.tv or drop them a line via PreneurCast@PreneurGroup.com.